Joining us now for an extended, important conversation here on your conviction to be in the equity markets, Brian Belski, Chief Investment Strategist for BMO Capital Markets. I'm sorry, Brian, for me, always and forever, the Bank of Montreal.
Oh my gosh.
Brian, Brian, I want you to talk about what I've lived, and a lot of younger people have never lived it. If price goes down and yields go up, stocks can still do well. Discuss that.
They can do very well. And thanks for mentioning Nick Roccanova, too. First of all, one of the best names in Wall Street history, number one. Number two, the poor man has worked with me for 18 years, so we should all pray
painful.
for him. I'm coming live to you, by the way, from the wonderful Jennifer Lee's office here at BMO headquarters in Toronto. So I feel like I'm in the midst of greatness.
In the glow.
Yeah, exactly. So I really think we wrote this piece and talk about voluminous piece. Nick lets me go crazy on the year ahead piece. We wrote this piece in 2022 for the 2023 year ahead, and we talked, Tom, about normalization in markets, something we talked about last appearance as well. And stocks can go up when yields go up. The average 10-year Treasury the last 75 years is 5%. 0% is not normal. What's happened in the Fed since August of 2007 is not normal. And I think we're kind of returning to normalcy. On the bond side of things, even though we're primarily equity people, we believe the majority of returns, total returns of bonds the next 10 years is going to be about yield, not price performance. Remember, the last 40 years, we've seen massive outperformance of bonds for the most part, and we've had great price performance. So I think, Tom, that we're entering into this period where more even returns for stocks, high single digit, low double digit, same thing with earnings growth, where a yield environment that can kind of hover in this 350 to 450 range predominantly.
So, even though you maintain, and rightfully so, Brian, your bullish stance here, I mean, it's been an amazing rebound in this market here. Still, your EPS for the S&P 500 still around $250. Does that support higher stocks from here?
It does. And we're in the bottom of the report, Paul, we talked about how we're not revising back to our 6,700 target, which was officially our initial target for 2025. It still remains our bull case at 275 for earnings and 6,700 for the price. However, as we wrote in the piece, we need to see some signposts, quite frankly. And one of them, to be clear, is we need to see guidance come back and we need to see earnings growth solidify. And so we think we're going to probably see that. So with the market, we're transitioning to show me from scare me. And I think the next quarter or two, which is a long time in Wall Street, brothers, a long time, the next quarter or two, I think we need to see earnings growth come in, and then we'll feel better about returning to our bull case at 6,700.
To get to a 6,700 target, does tech have to be a leadership category, Brian?
That's a great question. Yes and no. We don't think Meg 7 needs to be leadership. Meg 7 is all about liquidity. Tom and I talk about the 90s, and these stocks are the new consumer staple stocks, as we talked about, these big cap, these mega cap tech stocks. We're technically underweight the Meg 7 because we own zero Meta in our $11 billion that we run for BMO. But I think it's going to come from other areas of tech, whether or not it's bottom fishing in AMD or the great fundamental story of Palantir, or buying the dip in Palo Alto today, which the major theme of AI, we think, going forward is cybersecurity. It's maybe moving down in cap to a cyber arc with respect to cybersecurity. And even Oracle. Oracle's not in the Meg 7, but we're talking about a multi-billion-dollar company with a fantastic balance sheet and a great software company. So I think it's going to be other areas in tech, Paul, that outperform. And that's why we continue to be overweight, with respect to the technology sector.
So, Brian, it seems like, again, the volatility that we've seen here in, the first 5 months or so of the year has really come out of Washington, D.C. with economic policy, trade policy, just kind of bringing in a level of uncertainty into the markets. I'm not sure that's going to necessarily change going forward. How do you kind of come to grips with what is still going to be a higher tariff environment out there?
Right. That's one of the points that we make in terms of our signposts. Markets have to stop reacting to every little thing out of Washington, whether or not it's good, bad, or indifferent. And once we kind of get back to quote unquote business and normalcy, I think we'll feel better about the bull market, which remember, we're still on big, giant, secular 25-year bull market. But again, given this uncertainty, I think too many people are trying to make the big call and go right back up to 7,000 on the market. The market needs some work to do. It doesn't mean we're not bullish. It just means we need to see some fundamental work.
Brian Belski on the X-axis where I live, folks. He's with BMO Capital Markets. We will continue with Mr. Belski. He moves the markets. They go the other way. Futures at -41, Dow futures -389. The VIX out of stick now, 19.11, a full big figure there. The 30-year bond, 5.01%. Yields actually come in, price up, yield down in the fixed income space. Just got a note from Jack Fitzpatrick in Washington. We're efforting Mr. Fitzpatrick now through his wall of interns. And he says they're in the rules committee after an all-nighter.
Ooh.
And they're stalling.
Really?
Which is what we used to do. We'd be at Jay's Diner.
Yeah.
We'd get there like at 11 p.m., take over, the Jay's Diner kind of thing and eat first. Got to eat first.
Yeah.
And then lots of coffee and, try to get a C in the 3 exams the next morning.
Exactly.
Why don't you go back to Mr. Belski?
Hey, Brian, I'm looking at what we haven't talked about a lot really this year with all the talk on tariffs. We haven't talked about the Federal Reserve and interest rate policy here. Do we need the Fed to be accommodative here for this market to work?
I don't think so. And I think that's really the secret sauce there, Paul. I mean, I think at the end of the day, the end of quantitative tightening, rates are still low relative to history. The Fed has a dual mandate. Employment remains very strong. Remember, employment is the laggingest of all indicators. It always happens last. And then on the inflation side, as you're talking about CPI, we'll see how PCE and all that kind of comes in going forward. But I think the Fed is done. I'm one that says the Fed's actually done a pretty good job. And so I don't think that we don't need an interest rate cut for the markets to go up.
What do we need in terms of, just from the companies themselves? How do we need for these companies to step up and say we have better visibility, more visibility, any visibility on our earnings? Because the first quarter was kind of characterized as a lot of companies, rightfully so, just saying we don't know what's going on out there.
Right. And that's part of our signpost that we need to see guidance and earnings kind of growth numbers come back, meaning the show me side of things, Paul. And I do think, obviously, first quarter, the majority of earnings didn't have tariff-related type of issues. But at the end of the day, we want to see companies that have strong operating results, that operate from a bottoms-up basis very strongly, and have some guidance that say, hey, you know what, tariffs, smariffs, we're still going to have very strong and steady earnings. And, oh, by the way, you get what you pay for, and you know what you're paying for in U.S. stocks. And so I think that's going to be the theme for the second half of the year.
Brian, have we ever seen retail and institutions so far apart? I mean, I got retail buying the dip. That's all there is to it. Belski's going to these Florida, Caribbean island stock conventions. People are day trading off their laptops while Belski's giving them pro tips. Okay, retail's all in, Brian. Institutions aren't. Has it ever been this nuts?
Great question. It's been on the other side. I would say, I remember having very complex and aggressive conversations with private wealth in March, April of 2020. Institutions were still late in getting out, Tom. And I think also too, I go back also to October of 2000, where retail was the opposite side. Retail was all in. Completely all in, and you started to see the technology crack a little bit. In the U.S., foreign investors were still very, very aggressive. I, quite frankly, hate the notion of retail's dumb money and institutional's smart money. It's actually the opposite. It's actually the opposite. And I think that's part and parcel, Tom, quite frankly, to what happened in the late 90s, because retail private wealth really learned their lesson to be too overexposed in stocks, and wealth managers have done a wonderful job kind of diversifying. So I think it's the dumb money is actually the hedge funds and the short-term money that's trying to chase these momentum moves. And oh, by the way, they've been wrong.
Is that because they have access to leverage? I mean, there was a white paper years ago. I'm sorry, folks, I can't cite it. That if you get out over 2.8 to 1 or 3 to 1 leverage, things fall apart. I mean, it's just about institutions are leveraged up, and that's where they get into trouble.
I think it's part leverage, quite frankly, but it also, I think, too, is that institutions, they own too many stocks in these big portfolios, and they haven't made the right bets. And I think that they're chasing momentum, quite frankly, and there's not a lot of independent thought. When I go in and talk to a big institution, Tom and Paul, and I start talking about stock picking, it's like their eyes gloss over, because for the most part, they're just kind of chasing the momentum. They don't really want to talk about operating performance and management and product and service. So I think that's kind of the rule we're in. And oh, by the way, retail, i.e. private wealth, they love stories. They want to talk stories about stocks, and institutions have kind of forgotten how to take stories.
Really, that's really interesting. I'll have to have you back for that. I got one final question. Knicks or Pacers?
Knicks, come on. The Wolves choked last night. I want to see the Cat taking on their old team, the Wolves. So we got to get going.
Brian Belski, thank you so much. BMO Capital Markets.